on the first slides just about Buynomics and the speakers. Yeah, so my name is Paul Hanke, and unlike the name that you can see here on the Zoom screen today, I'm head of sales at Buynomics. I'm leading content and insights, previously worked in consulting, and I'll be answering any questions you might have in the chat today, and also happy to follow up by email if you have any questions about working with Buynomics, about the solution and these types of things. And our founder, Ingo Reinhardt, will be moderating or leading the webinar today. He has over 12 years experience in pricing and developed the Buynomics method, and he's also the author of the recent white paper that we wrote on the evolution of pricing. So he's really the expert on the topic here. And yeah, looking forward to the session. Quick word about Buynomics. Buynomics is a revenue management and pricing solution, which is really developed around 4 key value pillars, as we call them. It's a holistic approach, so no like simplistic pricing, pack size, and promo analysis, but a really holistic view from the consumer or shopper perspective. It's a very accurate model. We have over 95% accuracy in a lot of cases, and that really gives you the trust that you need to make better decisions. It's also a very fast solution, as you'll see. If you book a demo with us, it's a very quick way from hypothesis to insight. And lastly, this also yields higher profits for our clients. And happy to discuss that more if you're interested in our solution. But I think with no further ado, Ingo, I'll hand it over to you. I think a very interesting discussion today. I see more participants joining now. So let's kick it off with the content for today.
Perfect. Thanks, Paul, for the introduction. I think I can skip that. That was also in there. So before we get into the core topic, evolution of pricing, well, I think it makes sense to step back a couple of years. Let's remember why pricing is important, and I think there's not too much effort to spend here, because I think we're all professionals in the field, so we should all be convinced of the importance of the field. But here's an example that we had with one of our customers, and this is in the consumer goods industry, a product where at the start of a test, they essentially what happened was that their two predictions went against each other, one using price elasticities and the other one with our tool, and we essentially followed this experiment, and what they did was they started off with a product, had 12 million in sales, annual sales for the product. It sold at 329, and they increased the price to 379. And the elasticity-based model suggested that sales would go down to about 10 million, so about 20% drop. Using the solution that we suggest, and which we will come to at the end of the talk very briefly, suggested that losses would be much higher, losing about 2/3 of sales. And this example shows what's going on in the background. It's a very complex markets, lots of alternative products, lots of very close alternatives to customers that are very difficult to capture with the price elasticity. And this just shows how expensive in this case here it can be to work with inaccurate methods. So just to kick off with the mention that pricing is important, massive lever for the company, but as it is important, it's also important to get it right, and this is why we're talking about pricing methods, and today particularly on the evolution of pricing methods. What's the challenge? What are we talking about? I think if we structure it well, in today's view, and I think we all share this view, I think there are two key challenges of a combination for a company. every company faces. It's one is value creation, build products, handle the logistics, supply chain, marketing, brand creation, and so on, everything that. And then in the end, there is the second part, the value capture. So how much of the value that a company creates is actually obtained by the company. And in pricing, we're mostly focused on the second part. So what share of the value that's created by a company is then kept by the company. So pricing is here really the key part in creating value for the company. And typically there are different objectives for or goals for a company. Like the most common ones, increasing sales or market share, revenue maximization, profit maximization. And I think particularly the recent developments in stock markets showed that while in the past month there had been particularly in the tech sector, a massive emphasis on growth over profitability. And it looks like this is moving back to a state where companies or particularly investors are beginning to favor profit again over growth and market share. And I think for us as pricing professionals, that's an idea that's very natural to us, that we favor profit, which is what companies need to be successful in the long run. So just to set the stage, and now let's dig into the evolution of pricing. And I think it makes sense to essentially start at the very beginning. And from our research, I think it's fair to say that pricing is essentially as old as money. As soon as people have money, they have to think about or are trading in goods. What are the proper prices for goods? How many sheep to exchange for one cow? All of these questions immediately lead to the question of pricing. And when you look at older texts like the Old Testament, the Code of Hammurabi, you will also see that there's sort of pricing advice in these older texts. And we just took one example here from Leviticus, and it essentially says, I'll just quickly read it. When we make a sale or buy from our neighbor, we shall not wrong one another. So in early pricing advice, the focus very clearly is not on profit maximization, market share, or any of this, but essentially the focus is on keeping harmony in the society, being fair to one another. I think most of like older societies living in smaller communities have this idea of repeated games where it's important to maintain fairness, which is also reflected in 10 Commandments and other rules that organize how communities live together. And I think pricing essentially is one of these elements that are important for people to live together. Most of the concepts in pricing that we are using today, like price elasticity, value-based pricing, essentially go back to probably the end of the 19th century, in neoclassic and to neoclassical economists like Alfred Marshall, for example, who studied supply and demand, and many of our concepts like a price elasticity essentially comes from here. And the reason why this happened at that time is that in other fields, mathematics, physics, the proper methods became available through calculus and other tools that then could also be applied to economics and then serve as the basis for the tools that we use today in pricing. But these come essentially with a set of key assumptions. So I think we all know these assumptions. So you assume when you have a demand function that there's atomistic demand. There are many small buyers. They behave rationally. All of these assumptions you need to make to be able to build a demand function and use essentially tools like a price elasticity. And with this simplification, you can immediately do a number of useful things that I think most of us are familiar with. So if you have if you know the price elasticity of a product, it's then very easy to compute the profit optimal price. For example, in the optimum, you always have the condition that the margin times the elasticity is -1. So for example, if you have a product that costs you 100 euros to make, you have a price elasticity of -2, then that means that the profit optimal price is 200, because you need to have a margin of 50% to be profit optimal. So once you have used these assumptions and use the tools like price elasticity, it's very easy to compute optimal prices. You can compute the profit optimal price. You can also compute the revenue optimal price, which is always a place where you have a price elasticity of -1. Problems immediately become then obvious, I would say, when we have something like a linear demand function here, which means that the price elasticity is different in each point. So if you change the price, if you have a price elasticity of -2, you change the price a bit, then price elasticity might go up or might go down. So that's when these tools become more difficult to use. Another part that's, I think, rooted in neoclassical economics, pretty much in the 19th century, is the beginning of value pricing. And I think one of the first ones to study heterogeneous resources back then. So they were looking at not at heterogeneous products, because most of the products they sold, like crop, wine, and other produce, were still considered mostly homogeneous, but they were looking at different resources or different input factors. So different pieces of land were differently fertile, and some might produce twice as much output than another one. And that's how differences in resources became a major topic. Ricardo is probably the most famous name here. And this is probably what then led, so where you have heterogeneity in input factors, then the next step is, of course, heterogeneity in output factors. So for example, different brands, that people, customers value different products also differently. So also you could say that value pricing can be rooted to some extent back here to another part later, I would say, plays a role in terms of the psychology, conjoint studies, and other topics that then helped researchers make this part measurable. So this already leads us, I would say, to the third major pillar in the evolution of pricing, is coming from a neoclassical point of view, where you say, okay, everyone's rational, like commander data from the enterprise, maximizing utility. They can consider all the product alternatives, and then they make consistent decisions. This is what you need for the demand function on the previous slide. But most of us know that this is a very strong and probably unrealistic assumption, because most people are Homo sapiens, not Homo economicus. They are irrational. They use simple heuristics, and that lead to phenomena like price thresholds, people preferring the middle option in a good, better, best offer, and so on. So this is, I would say, the third major tendency in pricing, that you move from a very simplistic or simplified model of how people react to price changes, to product changes, to a view where you consider the fact that people can behave or often behave irrationally, and you try to understand what role that plays, and as a pricing professional, how we can use also the irrationality of people to structure or optimize our offer. And there are many many different phenomena that can play a role. Something like substitution effect, where customers substitute a more complex decision with a more simple one. Things like anchoring, where you show a high price and you show the reduced price to suggest that this is a specifically good offer. So there are many techniques that come from the fact. But I think an important problem here is that if you combine something like behavioral pricing with something like a price elasticity, you always have this conflict in different assumptions. They come from different traditions, and these are very difficult to reconcile and put together in a simple framework where, I don't know, you set a price using price elasticities and then use something like a price threshold or a good, better, best logic. On top of that, there are always problems that arise from that, because they come from very different assumptions and very different traditions and backgrounds. But essentially all the pricing tools, and I think we've put together here the most relevant ones, come from these traditions. So something like a cost plus pricing, you could argue comes from the very early roots based in fairness ideas. So there are many examples of that. For example, many hotels, many restaurants, they have this logic where they say, okay, what should a meal cost? And they just take the cost to produce it times 4, and that's their sales price. And why is that a good rule? Because that rule has been applied for a very long time, and it has been considered fair by most customers. So that's a simple rule and consistent with this fairness tradition that I outlined a few minutes ago. And that would be one example. So where you say, okay, cost plus pricing is not aimed to maximize profit. You just use a markup that's accepted and has been around for a long time, and you can sort of trust that that's also going to work in the future. Similar with something like competitive pricing, where you say, okay, there's a strong competitor in the market, and I'm maybe a little bit better or maybe a little bit worse, and I can mark up or down compared to this competitor. And this is also a very simple rule of how to set prices. And you could say, if the markup or markdown to what compared to a competitor is fair, that also your pricing then belongs to this tradition. The next two examples, elasticity pricing is explicitly aimed at optimizing, but it always has the assumption is always based on the assumption that you have you oversimplify essentially the context in which you're working to come to the conclusion. And the fourth example here, value-based pricing, as I said, can also be traced back to this tradition, but what it often doesn't properly do is it is not really optimizing pricing. You try to understand what are the proper price differences between different products. But in this example here, we have a ski jacket with synthetic and down fillings. And these differences in markups or markdowns here, the down filling plus $50, these are typically also based on a very simplistic approach where you look at average willingness to pay for different customers. And in these systems where you end up with a portfolio here with ski jackets, they are typically not aimed at an optimized solution. So they address or they implement a price structure, but they're not properly optimized. Also because the approach is typically very simplistic, and anyone who has ever applied this value-based pricing knows that it follows essentially very simple logic, typically implemented in an Excel sheet where you have sort of agreed markups or markdowns for your different properties. And then the last step, also I think most of us are familiar with that, is good, better, best. So a psychological pricing, a behavioral pricing, and one of the most famous examples of that is a good, better, best logic, where the logic is you essentially have 3 products. Most people are risk averse; they will go for the middle one, and you typically have the best price a little bit higher than is correct, so that the middle option looks a bit cheaper, and that takes advantage of the fact that people are risk averse. They don't want to have the most expensive one and go for the middle. But again, here it's very difficult to reconcile this behavioral pricing with the other approaches. So there's not a straightforward way to set up a good, better, best portfolio in line with value pricing and optimized using something like price elasticities, and again, optimized towards the competition. So these different concepts, and I hope I could make it clear why that is. They come from different traditions. They are based on different assumptions that are often incompatible. For example, with behavioral pricing and elasticity-based pricing, one assumes rationality, the other assumes irrationality. So these things are very different to put together properly. And I think the other major challenge with these approaches is that they come from a time when computers weren't really available. A couple thousand years ago, for the traditional methods, for the neoclassical methods, end of the 19th century. So they were essentially built for a world in which where you have to come up with solutions via paper and pencil. And they often don't take full advantage of the technologies that are now available, particular big data, so the availability of large amounts of data, and machine learning, so a technique to analyze more or less unstructured data, as we have when we look at sales data, price data, and so on in a complex market. So these tools are not properly made for this world. And I think those are two challenges. And I think that's also why now these techniques are available, big data, machine learning. It's a good time to look at what might be the next paradigm, or what's the proper method to take advantage of these new abilities. To summarize, I think from our point of view, there are three key steps or waves in the evolution of pricing. One were these very traditional guidances focused on fairness. You could argue today manifested in something like cost plus pricing that's not aimed at optimization, but it's aimed at having a solution that has been used for a long time and it's considered fair by most people. In the second wave, optimization and quantification, which we find in things like price elasticity pricing, value pricing. And I think that the next phase is the one that actually takes advantage of the technologies that are now available, and which I want to highlight. And that's also the thing that we spend most of our time with. And it's what we call the virtual shopper or virtual customer. And the idea is essentially to have a solution that, or an idea where we simulate the full complexity of, or the full relevant complexity of customers' buying behavior. So essentially we have a large set of these virtual shoppers. They can be irrational, they can be rational, have certain behaviors. They can fall for price thresholds. They can have a preference for the middle option, as I outlined, and they have preferences for different brands. For some might like brand A, some might like brand B. One likes a strong engine in an automobile. Someone else is okay also with a smaller engine, and so on. So they have very different preferences. And the idea is then that these virtual shoppers or virtual customers collectively behave like real people. Because the focus of pricing is if you can predict how customers will react in a certain situation, how they will react to a price increase, as in the example that I showed initially, or how they react to a change in a product. If you decrease the size of a bottle here from 0.5 liters to 0.3 liters. If you can predict how customers will react to that, not only how much more or less you will sell from the focus product, but also how customers change between products, then we know all we need to know to make good pricing decisions, because we can very well anticipate how they react to any change in our offer that we make, or also how they change to competitor offers, and it tells us what's the best solution for us to react to a competitor move. So here's the core idea, and I think this is the way forward. So we have these virtual shoppers here on the left. They all have different preferences for brand A, for brand B. Here are the different products that are made up of these different value drivers. And here we have an example of these virtual shoppers. They all make decisions. And for example, if we on the right side increase the price of the product one, then fewer of some of these virtual shoppers down here will change their decision. So, and if I increase the price, some will not buy product one anymore, but they will move maybe to product two or product three, or they will not buy anything at all anymore, like these gray guys down here. And with this, I have the opportunity to look at a very complex offer, as most of us have in real life situations, and then be able to predict how they react to changes. And I just want to show this in a very, very brief example. I think we only have a few more minutes left, so I'll be very brief here. Just give me 1 second. Paul, can you see my screen?
Yes, I see it.
Perfect. Just move me these. Let me move these things. So here's an example of a real life offer. So we have 4 products. We're selling peanuts at 1 kilogram, 750 gram, 500, 250 gram. And we have 3 competitor products from competitor A and competitor B. We have, as most of us have seen in something like a conjoint study, we have the ability to define the different value drivers that make up these products. So here we can choose the size of the product. We can choose the brand. We have our own brand. We have all kinds of different competitors. We can choose if we run a promotion. So here now we have no promotion. Could be a type A, type B promotion, for example, flyer or shelf promotion. So everything like this. And this offer we can show to these virtual shoppers. Happy to discuss afterwards how they are created. But here, just very briefly, how these things work is if I have a price increase in one product here, increased by 20 cents, then I will lose a number of sales, and some of them will go to other products. Here in this example, luckily, most will buy my own other products, and only 5 will go to a competitor, and 5 will not buy anything at all anymore. And this is just to highlight that with a technology like these virtual shoppers that are capable of replicating the relevant complexity in a market, you have a tool that is able to model the real complexity in a market. And looking back at these traditional methods is also capable to reconcile the different ideas. So you have something like a value pricing. So these are different values in these products, exemplified by their size. You can have competitive pricing, so they're competitor products, and we can model the relationships between different competitor products. And and we're also able to consider price elasticity. So we can look here, for example, at an analysis, what happens if each of these products is changed in price. So all of this with a full simulation like this, where we have the option to manage the full complexity, whereas the traditional methods only typically look at one aspect of the actual complexity. And with something like this, we're able to bring it all together and assess the different ideas, value, elasticity, competitive pricing, and also behavioral aspects in one go, and essentially bring it all together and be able to use the full complexity of data. Let me go back to the presentation. Paul, can you see the presentation now?
Yes.
Perfect. Yeah, so this was just a very brief example, and let's go straight to the questions. If you are interested in the full details here, we have written a white paper on the topic, evolution of pricing. I think that came out a month or so ago. And if you're interested, it's on our website. I think we'll also put it in the notes to the webinar, so that you can download it. There, it's written in a more extensive way than what we could cover here today. But if you're interested, we have the full content there. And yeah, let's take a few minutes for final questions.
Great. We have quite a few in the Q&A, so thanks for all your questions. Soban is asking, would like to go back to that slide where you predicted the sales versus traditional. Interested in how, in the how part, how were we able to make predictions with 95+% accuracy?
Yeah, it essentially was using the tool that I just highlighted very briefly. And the advantage of that is that it was it uses the full complexity. If you work with traditional methods, a price elasticity, it's very difficult to consider what else is going on in the market. So if you have price changes in your own products, or if competitors also make changes, or you have a pack size change, all of these things are very difficult to model. This is something that our solution is able to do. So you can make the changes that you know you will make in your own products. And this gives the tool the ability to be so precise here. Happy to discuss this afterwards.
Yeah, I think in terms of deep dive into the method and how that works, we would have to have another session, but we can also recommend some of the other webinars that we had on AI and the virtual shopper method. Someone's asking, do you calculate volume transfers from doses sold or units sold? Mainly from units sold perspective, but obviously it's something that you can also input into the solution, any kind of volume metric. Where you say, okay, for instance, if you work in the beverage industry, you're probably looking at cubic meters or liters or gallons or something like that. So that can be included. And if you're more measuring in doses, then that is also something that we can do. Someone's asking, is it fair to assume that Buynomics is focusing on B2C companies? At the moment, we decided to go ahead with more B2C focus. And in the future, hopefully, we'll get back to some B2B business cases, which we had some success with in the past, but we're just seeing a lot of traction in the B2C space, so that's why we're focusing on that. Someone's asking, does the tool account for brand equity, also packaging, labeling, design appealing, related to neuromarketing? And yes, so basically the way it works is that it looks at the value drivers, so those drive decisions and purchase behavior of a lot of categories.
Paul, I don't know.
Was I gone?
I'm not sure if it was just me, but I think, yeah. Like the last 20 seconds or so.
Okay, the hotel internet is not great. Sorry about that. So basically, the model works based on attributes which drive sales, and brand equity, packaging, labeling are part of that. So yes, we do account for it. Someone's asking, can you capture purchase frequency change from moving to different pack sizes? Ingo, do you want to answer that one? So basically,
the short answer is yes. Also happy to take this offline.
Okay, perfect. Someone's asking how we generate virtual clients. That's probably also something we can take offline, but read or which has a good understanding of preference distribution based on historical sales data. So, yeah, happy to also go into more depth, but we have some information in other webinars there as well. And then can include manufacturer restrictions or time leads in the model. So we can include stuff like certain grammage, like corridors for sensible pack sizes, sensible amounts of gigabytes for telcos or software, price corridors. We can also include, for if you're looking into CPG, certain discounts and these types of restrictions that can be included. If you have more details, feel free to shoot me an email. It's in the chat. Okay, someone asked, I hope that they understood the neuromarketing related question. Let me know if you didn't, happy to answer by email. Yeah, and then someone's asking, can you share the product name this example was used? Unfortunately, that is confidential, so we can't share client product names. Great. Thanks a lot for all these questions. If you have any more, feel free to email us, and also be aware that we have an upcoming to go to the next slide. pricing and revenue management strategy, as well as a couple of more insights on our website, and you'll be receiving the record and your spam folder on Monday, Tuesday. Great.
Perfect.
Thanks everyone, and we'll see you at the next webinar.
Thank you very much. Have a good weekend.